Good afternoon. My name is Jonathan Levin. I'm a Bloomberg opinion columnist, and I'm here with some friends. Allison Schrager, economist, senior fellow at the Manhattan Institute, author, and Bloomberg opinion columnist. I'm also here with John Leer. He's the chief economist at decision intelligence firm Morning Consult, and we're here to talk about Fed Day. As we usually do on these, we're going to give you some real-time reaction when the decision comes out at 2 p.m. in just a few minutes, and we'll be out of here before the Powell presser starts at 2:30. I'll give you a very brief sort of intro, and then I'll kick it over to John to hear what his expectations are. But effectively, the market really expects the Fed to do another 25 basis points here. That'd take us to a range of 5.25 to 5.5. That's a 22-year high. The Fed really doesn't like to surprise the market, and this is something that is priced in, which is why a lot of people feel pretty confident that that's what they're going to do. If you looked at the Fed's summary of economic projections, they insinuated last time that they would do another 50 basis points of hikes, so that would mean potentially another one even after this. At at the same time, we just got a really, really good inflation print. A lot can change over the next, 2, 3 months. So we kind of have to. John, with the 3 minutes we have before we get the decision, what are your expectations here?
Yeah, I would agree that 25 basis points is the most likely outcome. I guess maybe my biggest sort of contention or point of disagreement is just sort of how maybe you read that last CPI print. So I think there are two things. One is, right, the Fed is very explicit that they care about core PCE. Core PCE has run slightly hotter than core CPI, and you really haven't seen that sort of decrease in core PCE that we have seen in CPI. And then the other point maybe is just that inflation, tends to be, you could call it non-monotonic or something. It's going to fall, but it's likely to come back up again at some point. We really just have one data point, and so I would look for the Fed to really focus more on sort of what they've seen over the last 6 months, which is really stable and elevated core PCE.
Okay. Allison, what about you? You had a great piece out in Bloomberg Opinion, thinking about recession probability, but you were also a little bit, I guess, bearish. You could say a little bit concerned about the inflation outlook. You said, look, on the face of it, aren't where they're supposed to be. They're certainly not 2%. So how do you think the Fed is thinking about this going into this one?
I mean, I think they have the same concerns. My point was really, like, I was sort of disturbed, and I've actually been team soft landing for a lot of the time. But I think once everyone had declared victory, when core PCE was still about 200 basis points bigger than it should be, this is when I get nervous and I just get the montages in my head of economists claiming victory and then there being a bad recession. So I might just be superstition, or it could also be that I saw these claiming victories alongside wow, a lot of troubles brewing in debt markets. Um, and, as I said, the Fed still has work to do. And there's a lot of potential headwinds ahead. So I think we just have to be modest and say, this is the data we have, but it doesn't really tell us much about the future right now.
Sure, sure. With the last minute, I wonder, John, how are you reading the job market? Because one of the things I'm really curious about, they had this line in the last statement: job gains have been robust in recent months. I'm wondering if they'll stick with the word robust. What about you? You think
Yeah,
it's
I
pretty
think they will.
robust out there?
I think they will for a couple reasons. Not only have they been sort of above average, above pre-pandemic average, but you're also seeing that the job growth has persisted despite all the concerns that we saw in the tech sector, and then some of the sort of the SVB and the banking crisis issues. And we really haven't seen those sort of spillover effects into the jobs market yet. And then on top of that, wage growth, while moderating, is still well above, I think, where they would like it to be consistent with that 2%
Sure.
core PCE target.
And to that point, towards the end of this week, we're going to get another ECI, right? ECI past measures have suggested that we're running around 5% wage growth. That's clearly too hot for the Fed to get comfortable with. If we see it come in closer to a 4%, maybe that changes their mind. But here we go. In a moment, let me just pull up my screens to bring the results to you. So as expected, uh, they raised by 25 basis points to a new range of 5.25 to 5.5. I did just want to quickly pull up a screen and see how the market is reacting to this, if at all. So you get that sort of this funny kind of knee-jerk reaction in the 2-year Treasury note yield. It comes down a few basis points. It's just kind of a funny thing that the market often does when you pass the risk moment. There's this kind of funny thing that the algos tend to do, but it's hard to read too much into this. I did just, real quick, I wanted to get into this statement in a second, but coming back where we left off before we went into the decision. So we were talking about that labor market. Just to put some numbers on it, you take a 3-month average of the past, of the recent payroll reports, you're looking at like 240,000 jobs a month. So that's certainly not bad news. That's not recessionary. Is it? Is that in and of itself too hot to handle for the Fed? Are they targeting something specifically? Do you think? Either of you want to take a stab at that one?
I'll let Allison weigh in.
I'm not, I mean, I would hope they're not, because just monetary policy doesn't have that level of precision. I mean, I think they could say that, labor market's still tight, but getting a little bit less tight. And I think as long as the labor market, unemployment is well north of 4%, they're going to feel comfortable hiking if they feel it's what they need to do. And I think, I think we like to feel like, a quarter of a basis point here has this like profound impact and can get this very precise unemployment number or jobs number, and it really just can't. And I'm glad the Fed doesn't go too hard on that, because I think they know they would lose credibility if they did.
Yeah, I would. I mean, I totally agree. I think, the Fed cares about the jobs number insofar as they care about achieving maximum employment, but then also they're concerned about, what jobs demand might mean for wages and ultimately how wage growth is going to impact price growth. And so, I don't think that number in itself says anything. And in fact, when they laid out early on the sort of soft landing hypothesis, the idea was that you could conceivably have robust jobs growth without persistently elevated wage growth, because you're going to have people coming in off the sidelines. And so basically you would have this sort of, but I guess I would say we've seen a lot of that already. And this, I think it's a real open question. And I think it looks increasingly less likely that you can continue to support jobs growth just with additional labor force participation and not have that spill over and drive some of the wage growth.
Yeah, all right. So let's actually dig into the statement real quick. I put it up on our screen here, and the first thing I would just underscore is you're 1 for 1 on your forecasting record, John. They stuck with robust here, so well done. Job gains have been robust in recent months, and the unemployment rate has remained low. I'll put up the strike through in a moment when our team puts it out. But I wanted to underscore that. And then, I automatically go to the third paragraph where they
Can I just pause for 1 second? I mean, I do think it's important, right? Like the committee remains highly attentive to inflation risk. And I think that's the right way to think about it from the perspective of policymakers right now, is that they're making risk-based decisions. They know that they don't know everything. They know that it's almost impossible to know the future. And if they had to think about sort of weighing the risk of doing too much or too little, I think they still remain primarily concerned that they're going to do too little and not get inflation under control during this tightening cycle.
Sure. And then looking ahead, my eye always goes straight to paragraph 3. The committee will continue to assess additional information monetary policy in determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time. The committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. I'll dig out the strike through momentarily, but if memory serves, that's similar or identical to last time. They're maintaining the sort of conditionality around it. This language, the extent of additional policy firming that may be appropriate to return inflation to 2% over time. If you want to get really nerdy about it, right, there's like an upward bias that they keep in that language. It's not symmetric as they used to say. So if they're going to do anything, kind of, it's going to be toward tighter, not toward looser. But there you have it. Not a ton of surprises coming out of that. Let me just stop my share real quickly, and I will just to put an even finer point on that. Coming back to the market reaction, kind of like nothing right now. We are where we were when we started this conversation, and to John's point, and I think, in a sense, to the point of your column a couple weeks ago, Allison, like these guys are just trying to feel their way around and be able to react to risks when they come. We're potentially, I think, now in an every other meeting move kind of situation. I've kind of been trying to make this term of the Greenspan skip happen. I don't know if it's happening yet. Probably not. But this is kind of the formula that Alan Greenspan used in the mid '90s. I think 94 through 95. They kind of started to approach what they thought was an appropriately restrictive stance, and then they went to moves every other meeting, which has the effect of just slowing down the pace, right? If you're moving at a pace of 25 basis points per meeting, and then you start to go 25 basis points every other meeting, it's kind of like you're going from 25 bips per meeting to 12 and a half bips per meeting, or something to that effect. But they don't know what the future holds, and if they follow that pattern, they're really looking at like what economy are they going to have on October 31st when they make not the next decision but the one after that. So let's play a game of guess the future. What we have some things coming up. We have the student loan. Folks are going to start paying for their student loans again in September. Is that potentially a game changer, or at least something that the Fed wants to do before it commits to doing something here? Any takers on that one?
I mean, it could be. I mean, I think we've been seeing a lot of evidence that a lot of these borrowers, I mean, most of them actually were able to service their loans before we did the pause, but they've now also taken on a lot more debt. So that could, just as I said, increase credit risks across the board. I mean, you can't default in student loans, but you can on auto loans. So I think that certainly increases a lot of risk. I worry that right now, these decisions are fairly easy. Unemployment's low, inflation's still above target, but not that much above target. But what we might end up with is, as I said, more pressure from credit markets, and as John points out, another burst of inflation. And then they're actually going to have to be in a much tougher spot than they've been so far.
Yeah, my sense on the student loans is that there's a relatively small subset of the population that will be acutely harmed financially by this change, and they're going to likely go through additional financial hardship. I don't think that that's going to translate to broader sort of macro issues in terms of the sort of spending environment. But and part of that is because that's going to be outweighed, I think, by what we've seen thus far, which is positive for the first time in a while, positive real wage growth, actually sort of helping helping folks, adding a little money to their wallets from month to month.
For sure, and I did just want to real quick close the loop over here. I put up the strike-through version of the statement just to sort of fact check myself, and really there are no material changes in this statement. You see in the first paragraph, it had previously said recent indicators suggest that economic activity has continued to expand. Now it says recent indicators suggest economic activity has been expanding, and they changed modest pace for moderate pace. I'll have to get out my Fed if that means anything, but I'm pretty sure it doesn't. It certainly doesn't to me.
Can
But I go ahead,
Well,
jump
I was
in,
going to
John.
mention one thing, which is just sort of an arithmetic matter of arithmetic that I'm sure a lot of folks have thought through already, which is that going forward, as long as inflation is falling, real rates held, or sorry, nominal rates held steady are going to lead to effectively higher real rates. And so there's this world out there where they might do nothing, and that might actually make them more restrictive. And I think that markets maybe, or the commentary in general, has sort of tended to focus on sort of how rapidly nominal rates have risen, but real rates only recently became sort of contractionary. And so, yeah, I think we're likely to see sort of positive real rates for some time.
Are you taking a stand on our star?
Yeah, well, I think that's part of it, which is I do think, I think our star is
Can I
yeah.
just jump in here and ask one of you to define R
Oh
star for
yeah.
our audience?
I guess I would call it the policy neutral rate, which would be the real rate where monetary policy is neither sort of expansionary or contractionary. And up until very recently, real rates were still zero or less than zero. So you would say that even really up until like several months ago, that the Fed was still in expansionary mode. And now real rates are what, like 2%? So, I mean, you could argue that is our star, now they're neutral, or it depends what you think our star is, but no one really knows. It's kind of this boogeyman that no one really quite can get their handles on. But that's why I was excited John took a stand on it.
It's
And just to add one thing to that, if you look at the summary of economic projections, the implication is that the Fed thinks that it's zero point 0.5 percentage point, basically. So go ahead, John.
No, I was going to second a lot of what Allison said. It's really difficult to measure. John Williams, the New York Fed president, is sort of the dean, I guess, of this with a lot of his research with different colleagues. His model suggests that our star has not materially changed following the pandemic, and that we're likely to see a lot of these sort of longer term trends revert back to longer term trends. I do think we're clearly in a world where we've experienced some structural changes on the housing front. I guess that would be my biggest sort of pushback against this sort of R star, the steadiness of R star, which is to say that I think our demand for housing as a result of moving, spending more time working from home is just going to be elevated, and that's a function of how we live our lives now. And so it actually wouldn't surprise me if a lot of the sort of cyclical um, um, variation that we're seeing in housing is actually going to sort of later down the line be reclassified as being a structural push out in terms of overall housing demand. That's maybe a little wonkier, but I say that just to say I think it's obviously very difficult to measure. The housing market is going to be very different now for the foreseeable future relative to the way it was prior to the pandemic.
Yeah, let me real quick bring it back to sort of the economic outlook here, because if we're thinking about what the Fed is going to do 3 months or 6 months down the line, I mean, a big question in everybody's models is: do you think there's going to be a slowdown? Do you think there's going to be a recession? And yeah, you have a bunch of dynamics that are sort of even working in favor of the bearish outlook in the sense that you do have bank lending coming in, you do have that excess savings sort of running out. But I put this screen up from John's research team because you do at the same time have consumer sentiment, the vibes, as my colleague Kyla Scanlon refers to them. The vibes have been really improving, and I wonder about the extent to which the positive vibes can start to carry us, perhaps for the foreseeable future, even as we get these other maybe macro headwinds in the form of reduced lending capacity and reduced excess savings, which was potentially a huge thing that has carried us in the past 12 months. How do you reconcile those various forces, guys?
Well, I think the concern is this could also feed inflation. Um, we see consumer sentiment going down as inflation fell, largely because, some of the inflation is supply driven, some of it's demand driven. But if sentiment's positive, then, it's going to put some of that demand back on.
Yeah, I think that's a great point. And in fact, you had mentioned earlier, Jonathan, about sort of what we've seen in gas prices, and I don't want to front run that, but that's been on net, I think, a positive driver of consumer sentiment over the last 8 months, which is having sort of stable or falling gas prices. It's been surprising to me how resilient the consumer has been in the face of some of these, some market turmoil, the banking crisis, the tech scare that we saw earlier on the hiring front. So at least from the consumer's perspective, things are looking up. And again, maybe the underlying fundamentals have improved as well, which is to say, finally now we're having positive real wage growth, which to Allison's point, I think on net that is inflationary. That's good news in the near term, but I think in the longer run, it means that we're actually just sort of fueling the fire.
Sure. Well, let me be a little bit provocative and just ask, to what extent do we think that demand fueled inflation in the first place? And if it didn't fuel inflation in the first place, do we think that it's now going to start to fuel inflation? Where do you guys stand on that debate? And I mean, I think there are a lot of good arguments on both sides, frankly.
Well, I think inflation, the latest bout of it, has had many fathers. I think everyone's looking for the one reason, but I think there was definitely some of it was demand driven, and supply driven at the same time, which is why it was quite so high. And as I said, what we're seeing is some of the inflation coming down, partially because of the lost supply issues have been resolved, but also, as I said, we're also, as consumers are blowing through a lot of their pandemic savings, and as I said, experiencing real wage declines, certainly as well backed off a little bit. So I think it's rare that actually you do have a purely, like, you can really subscribe to one or the other. So, and they tend to interact with each other, so it's hard to tease out.
Yeah, really challenging. I think, Bernanke and Blanchard have a great paper out now where they go through and try to dissect exactly what happened over the course of the pandemic. I think we're fortunate right now that it seems like a lot of the supply chain issues that we faced are in the rearview mirror, although it's not to say we won't have some unforeseeable geopolitical event in China that sort of, wreaks havoc on our supply chains once again. But at least when things are driven on by the demand side of the equation, I think the Fed is a little bit more, is better equipped to deal with those issues.
Sure. So turning now sort of to the expectations channel, which has been very confusing this cycle, right? I mean, there's a lot of research and theory going back like 30 years or something that suggests that expectations play a major role in inflation, both on the way up, but also sort of keeping it there. Um, Inflation expectations, the long-term inflation expectations sort of went up. They scared the Fed a little bit, and then, but they didn't keep rocketing up, and they seem. If you look at market-based inflation expectations, they've never been a huge cause for concern. But a funny thing about inflation expectations is that they are driven by
things that the Fed does not normally care a lot
about
at least.
officially, right? Energy prices, which we often think the Fed looks through, and supermarket prices, which we often think the Fed looks through because they're supposed to be volatile and so forth. So what do we make in the context of inflation expectations? What do we make of the recent spike in gas prices, both at the pump and in the futures market, which might be telling us something about energy costs, a few weeks down the line?
Well, I mean, we measure weekly U.S. consumer inflation expectations, and we clearly see a pretty strong negative correlation between gas prices and inflation expectations. So I think on net that's going to drive up 12-month inflation expectations for U.S. consumers. It's, we talked a little bit about this, but a lot of those gas prices, elevated gas prices, while they're highly volatile, they do work their way through eventually and start affecting the categories in core PCE. And so you see that in, all the shipping costs, the airline fare. There's a lot. It's an input cost to a lot of those things, and those costs tend to be baked in. There's a lot of upward rigidities. Folks buy longer term contracts at 12 months or something like that, and so there's not as much volatility there as there is on the sort of the retail side of things. On the business side of the front, we've seen small businesses, they acknowledge that inflation pressures are likely to ease, but they're really struggling right now with the sort of the how much of those underlying cost pressures should they pass through to consumers. And so that's, I think, a debate that hasn't fully played out. We really haven't seen on the corporate side of the equation, we haven't seen sort of those profit margins really erode to the point that cost pressures are not being sort of just passed through and experienced by other economic agents.
Yeah, I think John brings up a good point about one of the things that makes inflation, I think, so damaging to the economy. It's not just that everyone's poorer. It also introduces a new level of uncertainty into everything for businesses, where to set their prices, for consumers, like they don't know what eggs are going to be. And, if we think about finance, an asset that's more uncertain is worth less. So in a sense, that also impoverishes us. And I mean, just before we were both the New York Fed consumer expectation surveys shows anyway inflation expectations are going down. There's also a lot more uncertainty around those. John was mentioning the distribution has changed. I mean, you think like 3 or 4 years ago we were all so innocent and like couldn't even imagine inflation, and now we this will always be with us in a sense. And if inflation continues trending down, maybe we'll just forget about it. But if we do end up with new bouts of inflation like sort of flaring back up, then that uncertainty really could be with us for a long time and impact things like bond yields.
And Jonathan, can I sort of
Please.
there's a topical element out there right now, which is the UPS union bargaining, and I think that's where all of a sudden some of these inflation expectations become really interesting. I mean, our unionization in the U.S. is relatively limited, but if we sort of think about the global perspective, that's where inflation expectations are extremely important, and that those expectations are actually likely to be sort of directly embedded in the wage bargaining process and future contracts. And that's the ways in which, it's one of the ways in which inflation expectations become embedded in price reality.
Sure, sure. Let me just do a quick market check for everybody. So um, S&P 500 went into this down a little bit, and it's still down a little bit. Has been recovering a bit. Basically, this is this is a snoozer. But one thing I did want to point out is in this cycle, at least from like the beginning of 2022 through March 2023, the big moves, and they've typically been big moves in the bullish direction, have come when Jay Powell starts talking at 2:30. For whatever reason, the stock market finds the man has a very soothing voice or something. um, Interestingly, that has not been the case since March. Something seems to have changed a little bit in the perception of how Jay talks about this situation. Um, having having said that, I wonder what both of you are listening for most closely when the chair starts talking in about 6 minutes. Is there something that we haven't learned from this statement that you think he can really elaborate on for us at this point?
Happy to dive in, Allison. I guess there's a couple things that jump out to me. One is I wonder if he'll be explicit in talking about sort of where how they're thinking about this relationship between inflation and real rates. So will he be a little bit more direct there around sort of the desire to be contractionary for a while? I think the other piece is this housing piece. It's it's been interesting, thinking through the different ways of chopping up inflation and excluding different categories to see sort of what the story tells you, and everyone has a view of like what super core or extra core inflation looks like. And so I guess I'd be interested to hear him talk about some of these other categories, things like housing. I think gas prices, as you mentioned earlier on, that a lot of that research is showing that those prices do ultimately come through and impact other categories. And then maybe the last one is just looking at the labor. I mean, we talked about robust jobs growth, but to what extent are they sort of looking at some of these trends in wage growth and wage growth across the income spectrum?
Yeah, housing is a fascinating one because the way that these things sort of filter through in the official indices, like we sort of have some housing disinflation baked in for probably the next 12 months. Have seen this pickup in market prices of housing coming through. It's nothing crazy like what we were seeing in 2021, but you have seen already sort of a return to something like maybe like a 5% annualized home price appreciation. And if that were to take off, what does it mean for housing inflation in late 2024 or even 2025. So it'd be interesting to see how he's feeling the housing market vibes. What about you, Allison? What are you looking for from J Powell?
I think as well, like what he's thinking about credit markets. I mean, we're already seeing a contraction in credit being extended. His concerns, I've said about different debt markets. I think, to some degree, I guess that's the long variable lags and also just potentially a higher rate environment and what the damage that's going to do to the economy.
Sure, sure. And to the point on credit markets, when you look at various measures of bankruptcy prevalence, consumer defaults and stuff, the question always seems to be, are we normalizing as default rates and so forth tick up? Are we normalizing, returning to a pre-pandemic normal, or are we at the beginning of what looks like a dangerous trend? And I for one, would be fascinated to know which camp Jay Powell is in. Um,
Well,
all right,
it's certainly the case that I highly doubt that he's concerned about any one default or delinquency, and it's really a question whether or not these credit conditions will spill over and affect the broader economy. And that's, I think, where financial markets, following that SVB failure, just got things wrong, which was thinking that challenges in regional banking were going to spill over and affect the broader economy. It did not play out that way. I think the Fed briefly thought that that was going to be the case as well, and it's one of the reasons why they've come back and committed to hiking rates later this year.
for sure. Now, so, guys, I want to start to wrap this up, but just to close the loop on what markets think of this. We've got the S&P 500 down about 0.2%. Yields not doing too much with the Fed funds target range now at 5.5%, highest in 22 years. This was essentially baked in, but as we discussed not too long ago, the fireworks tend to come in the presser. So I'm going to let everybody go so we can all watch the fireworks. Thank you to Allison Schrager, my Bloomberg Opinion colleague, and John Leer, the chief economist at Morning Consult. Thanks.